Did you know that a 540 credit score can quietly rob you of tens of thousands of dollars over your lifetime? Literally. We are talking about brutal interest rates on car loans, completely rejected apartment applications, and mortgages that are just entirely out of reach. But here's the good news. Fixing it doesn't require magic, and it doesn't require paying thousands to some sketchy repair company. Welcome to This Explainer. I'm Zak, and here on Zak Wealth Files, my mission is to make wealth building and personal finance simple, accurate, and genuinely useful for you. Today, we're tackling one of the biggest financial pain points out there, your credit score. Let's dive right in and see exactly how a poor score can be systematically turned around.
So, what are you going to walk away with today? Well, you'll get a crystal clear understanding of the actual, real-world mechanics behind how a credit score is built. To do this, we're going to look at a highly verifiable case study of a real person, we'll just call him D for today, who went from a struggling 540 to a stellar 780 credit score in exactly 14 months. And I'm going to break down the exact math for you month by month. Look, there are no shady credit repair companies involved here, no disputing legitimate debt, and absolutely zero shortcuts. We are just looking at what specifically moved the needle and what didn't.
Before we try to improve anything, we really have to understand the foundational rules of how most scoring models actually weigh your financial behavior. Because honestly, this is where most people get completely tripped up. The scoring system is surprisingly skewed. The most widely used models basically look at a handful of factors. Payment history, which just means whether you pay on time, is the single largest factor. It makes up around 35% of your score. It's huge. Next is credit utilization, which is how much of your available credit you're actually using. That's the second largest, sitting right around 30%. The remaining 35% is sprinkled across the length of your credit history, your credit mix, and any new inquiries. Now, exact formulas do vary slightly between models, and the major companies keep their exact algorithms pretty secretive. But historically, payment history and utilization are your two massive levers. Focus on those, and you win the game.
Let's see how all this theory applies to a real-world scenario. 14 months ago, our case study subject, D, started his journey with a really common, struggling financial snapshot. These are D's exact starting numbers, pulled directly from his credit report. His score was 540, landing him squarely in the poor range. Notice the two missed payments in the past 2 years? Both were over 60 days late. Ouch. And look at his credit utilization, 88%. That basically means he was using 88% of his total available credit across 2 credit cards and 1 small personal loan. He was essentially maxed out. He also had a 4-year credit history and 3 hard inquiries in the past year. Now, he wasn't dealing with anything highly unusual here. It was just a tough period of unemployment that led to some missed payments and relying a bit too heavily on a credit card. It happens to the best of us.
The very first step in wealth building, or getting out of a debt hole, is always about stopping the bleeding. You have to stop the damage before you can actively improve anything. So for D, months 1 through 3 were absolutely crucial. And the very first thing he did, it wasn't glamorous, but it structurally changed his trajectory forever. He set up automatic minimum payments on every single account. Remember how payment history is that massive 35% chunk? Well, setting up autopay guaranteed a missed payment could literally never happen again by accident. He also completely stopped applying for new credit, making sure he avoided any new hard inquiries that could cause temporary dips. By month 3, just by stabilizing his situation and letting those older missed payments age just a little bit, his score moved from a 540 to a 580.
We are now in months 4 through 8, and I really want you to lean in and pay attention here, because this introduces the single specific lever that created the biggest score jump in the shortest amount of time. It perfectly illustrates the mechanics of utilization. Remember, D started with an 88% utilization rate, maxed out. General guidance historically tells us to stay under 30% for a healthy score and under 10% if you want an optimal one. So to tackle this, D actually took on a temporary part-time job, and he used that extra cash specifically to aggressively pay down his existing card balances, going way above just paying the minimums.
But here's the part most people get wrong, or they just completely overlook it. You can also tackle utilization by increasing the denominator. It's like a math hack. D called up one of his existing credit card companies and simply asked for a credit limit increase on a card he had managed to keep in good standing. By getting approved for a higher limit, and crucially without spending a single additional dollar, he instantly lowered his utilization percentage, purely because he now had more available credit to his name. Just look at the impact of those two actions combined. By aggressively paying down the actual debt balances and securing that one strategic credit limit increase, his utilization plummeted from 88% all the way down to a very healthy 22% by month 8. And in that exact same window, his credit score skyrocketed from 580 to 690. Guys, that is a massive 110-point jump. It was the single largest leap of the entire 14 months, and it was driven almost entirely by shrinking that one ratio.
Now, I've got to give you a really honest caveat right here. Requesting a limit increase isn't a guaranteed slam dunk, and you absolutely must check if your specific lender uses a hard or a soft inquiry to process that request. A hard inquiry could actually cause a small temporary dip in your score, which we don't want. You want to confirm their exact process beforehand to avoid any unintended damage. What worked for D's specific lender isn't a blanket guarantee for yours, so definitely make that phone call first.
This phase covers months 9 through 14. The biggest, fastest moving levers had already been pulled. The heavy lifting was done. What remained was mostly just the natural result of consistent behavior over time. By month 9, payment history and utilization were heavily working in D's favor. So he simply let time pass. He made sure to keep his old accounts open to preserve his average length of credit history, and maybe, most importantly, he deliberately resisted the urge to open any of those flashy new rewards cards you get in the mail. Because remember, each new account temporarily lowers your average account age and slaps a new hard inquiry on your report. By just letting his accounts mature and continuing to hit those auto payments on time, his score steadily climbed from 690 to 780 by month 14. Now, this jump was noticeably slower than the earlier one, but it pushed him firmly out of average and right into the very good to excellent tier.
We've gone over the theory, and we've seen how it works in the real world. Now let's pivot and turn this into the exact step-by-step action plan you can apply to your own money situation this week, regardless of where your score is starting today. Step 1. Pull your actual full credit report so you know your real starting numbers. You absolutely cannot fix what you refuse to look at. Step 2. Set up automatic minimum payments on every single account immediately. Make missed payments structurally impossible. Step 3. Calculate your current utilization and prioritize paying it down aggressively. This is your fastest moving lever. Step 4. Consider requesting a credit limit increase on a good standing account, but only after you confirm they use a soft inquiry. Step 5. Completely stop applying for new credit and stop closing old accounts while you are in this repair period. And Step 6. Just be patient. Let time and stability do the rest of the heavy lifting. Before we wrap up, let's quickly ground this in reality. This explainer is for general education. It is not personalized financial, legal, or tax advice. Scoring models vary, and your individual results will completely depend on your unique credit history. If you are dealing with seriously overwhelming issues like collections or you're considering bankruptcy, please go speak with a legitimate, nonprofit credit counseling agency. And crucially, listen to me on this one. Avoid paid credit repair companies that promise fast, guaranteed results. Legitimate improvement takes real time, and it comes down to mastering these exact fundamentals we just talked about, not buying a shortcut. D's massive jump from 540 to 780 was the direct result of making on-time payments impossible to miss, fixing his utilization early, and practicing patience. Fixing credit takes consistency, not a paid shortcut. So I want to leave you with a question. Are you going to keep letting a simple 3-digit number passively dictate your financial freedom, or are you ready to take the wheel and finally make the system work for you? If seeing the real month-by-month mechanics behind this transformation gave you some clarity today, well, that's exactly what we do here. Hit that subscribe button for Zak Wealth Files to get more numbers first explainers just like this one. And hey, if you're comfortable, drop your starting credit score in the comments below. No judgment here, only progress from this day forward. Keep building that wealth, and I'll see you in the next explainer.